Dow Jones Industrial Average ETF. First off, read this disclaimer carefully and do your good deed of today by liking and subscribing. So Dow Jones, it's definitively, the big boy in the market. We have a 33% move here from the 52-week low, approaching a 3% distance from the 52-week highs. So let's jump right into the charts. So here is the big picture weekly data points. For the SPDR, Dow Jones Industrial Average ETF, DIA is the ticker. We do have these large time cycles and also the small time cycles. So a pattern that seems to be repeating itself a bit here is that we have this, let's draw it in. At least since the dot-com bubble, there's been this tendency to have this initial rally, then a bit of a euphoric phase, and then the sell-off. So here we have the initial rally, then power mode, and then a pullback. But this one is a bit different, the current major phase. But we do have some similarities in that you initially do have this more careful rally like we had here as well. You could argue that this is the more careful phase. And then you have this euphoric phase here, which we had back here and here as well. And then after that you tend to have that pullback. So the expectation based on the time cycles and the previous price action here, it's pretty clear that we are very much expecting that to happen again. When we look here at the indicators, so we are already seeing some breakdown here in the MACD, so some bearish developments there. Even though the price is still going pretty strong, momentum has changed. If you look here at the RSI, PPO, we are still at historically very elevated levels. So let's go here to the daily data points. So first here we can look at the chart like this. What I find especially interesting here is definitively this blue 100-day moving average. We have seen that for quite some time it has been very important as a support level, and it has been a good time to buy the Dow Jones. It has a strong, clearly, as you can see, a tendency to work out. So this relationship with this moving average, it obviously is not random. This is a big boy moving average watched by a lot of people. We haven't broken it yet. So there is the potentiality of us bouncing in the coming week. However, there's a big but. If it were to break, that would be a very bad signal, because throughout this post-plunge rally, it has been support. The next support below that would be the red 200-day moving average, which we tested almost surgically back here. So if we lose the 100-day now, then there's a high probability that we will test the red 200-day moving average. Looking here at the daily data points with the indicators, looking at RSI, we have been lower during previous pullbacks. You see that it's rare for us to become deeply oversold here on the daily RSI, but it is actually very common for us to bounce from the low end, around 30. So there is the potentiality of more downside here. Looking at PPO, the distance from the 20, 50, especially like the 20 and 50-day moving average. During prior pullbacks, we have been lower before we formed the ultimate low. So that is just something to take into account. So yes, there is the potentiality of a bounce here, but if we do not get it, then the 200-day would be in play. Looking here at the seasonality. So the seasonality is beneficial here for the bears, because you do see a very sharp weakening over the last 5 years from July into October. The last 10 years, July weakening into September. So September, over the last 10 years, it is actually the weakest month. Over the last 20 years. Then we do see that January, June they tend to be weaker. But September, it is a mediocre month. We only close higher 50% of the time, and there usually is a bit of a loss. So September is definitively a risky period for the Dow Jones. Not disastrously risky, because we have overall, had a major bear in mind that the central banks have been incredibly supportive of the stock market. But everything has its limits, and there are like the very big fish like Ray Dalio that's talking a lot about the enormous amounts of debt that is in the financial system, and that there are these debt cycles. Usually, historically, well, the clear trend historically is that it doesn't work out long term. The debt cycles they are followed by major declines. Okay, that's just how history has played out. So here we have Finviz. We have broken through this diagonal trend lines, and that is a major point here for the bears. When we compare the Dow Jones against the world total stock market ETF, and we look here at performance, we do see here that it's pretty close here year to date. When we look at the price earnings ratio, 18.66 here for Dow Jones, 19.9 for the total world stock market. So a 6.6% difference. It is, however, important to be aware that Dow Jones, it does contain some very well, it does contain large cap stocks. And they don't have the tendency to have the higher beta that you see in like mid and small caps. Dividend is 1.60-ish here for both. Let's look at holdings. So 31 here for Dow Jones and over 9,000 for the total world stock market ETF. Here you can see the sector breakdown. So you do have a nice mix here in both. When it comes to market cap, Dow Jones is 100% large caps. Okay, so if I were to sum up my take here, I think that it is pretty clear that we are in a high risk period for the bulls. The key line in the sand, however, for a bullish thesis would be that 100-day moving average. If you lose that one, then the 200-day would be in play.